Hi everyone, I'm Sharanesh, currently pursuing my final year in electrical engineering. I'll be talking about the impact of low latency hardware in high frequency trading firms, probably known as the HFTs, in this presentation. So, moving on, let's just see what we all might be knowing what the basic trading is, how the day-to-day trading works in the stock exchanges, and how people used to sell or buy their own stocks at a price which they want. This is the day-to-day trading thing. But in using this, there are few firms called the HFTs, which basically like try to trade in really high frequency. High frequency here means that their trade volume, the number of stocks which they buy and sell, like are really huge. So that is the high frequency correspondence here. Using by doing so, they try to make a huge amount of money. So these companies. Will be like placing the orders at a very low latency at a very low latency speed, so which basically means that at a very high speed they want to get the market data immediately. They want to process it and they want to place the order as soon as possible so that they get the most money out of it. So for this purpose they try to use the low latency hardware, which can be either GPUs or FPGAs and so on. The traditional software-based mechanism will be slow because there is multiple transactions and multiple devices, networks and protocols involved before we get the market data, and then we place them on a software. Again, that software again needs to translate it into the NSE or the stock exchange servers. So yeah, that is the reason why we say that having really low latency hardware, and if the hardware is much closer to the market's data, then it would be much faster in placing the orders. Yeah, this is the like sort of the base for it, and we'll be talking more about them in the coming slides. Yeah, let's go about the agenda. So I'll be talking about what are HFTs, how did HFTs evolve, like the history of HFTs, and why are we specifically using FPGAs in HFTs. And again, nothing comes for free. So are they going to be really secure? And what are the boon and banes of HFTs? And what are the current trends and the future scope? Yeah. So what are HFTs? So the high frequency trading firms, they tend to use the advanced technology and algorithms to execute trades very quickly. They deploy complex strategies to take advantage of very small market discrepancies, and this which basically means that they don't perform long-term trades, which basically like they don't buy a stock and keep it vested for a long amount of time. They just try to buy the shares, and as soon as there's a very small change in price, a small marginal difference as well, they try to sell the stock immediately so that they can make a small amount of profit per stock. But since their volume of trade is really high, which basically means that the number of stocks which they're buying and selling is huge. So if you just perform the math, like a higher number of stocks into the very low price margin, it again gives a huge amount of profit. So that is how they try to make advantage of the small market discrepancies and trade in huge volume so that they make the most money out of it. And also, this is a highly competitive industry with many firms trying to make profits. This is again the basic trend that like if some industry is really hugely highly competitive, and we basically see many firms trying to come into it and try to get the market share. Also, these companies execute higher number of orders at a very low price margin, and also they execute multiple orders at a faster trade, hence the name high frequency trading. Yeah. So next, working of HFTs. So they basically have a, tagline called the tick to trade, uh, which basically means that like as the person who actually makes the lesser takes a lesser turnaround time in placing the order makes the most money out of it. So they employ a wide range of trading strategies like market making, statistical arbitrage, and trend following. So if you see market making, they uh, earn profits by placing a high volume of orders to both sell and buy the same stock, because uh, that is why then they get a smaller bid ask spread. But since the number of stocks they're buying and selling is really huge, their volume is high and they make more money. And information arbitrage, like they use computers to identify trends and such as like the news reports and real-time data on Twitter or those kind of things they tend to use in real time so that like they get that market trend as quickly as possible into their algorithm. And also they use like high profile algorithms in uh, predicting the market actually. So they with the past huge amount of past data, they try to perform prediction on what stock will be having what kind of trend in the near futures. Yeah, and also they also make profit by uh, like executing them in a very faster speed because they have direct market access. So which by direct access meaning like the NS the stock exchanges that directly gives them access to the market data. So in the stock exchanges actual location, we'll be having the HFTs will be given a space to keep their own hardware, and all the HFTs whichever are being placed in that particular stock exchange will be getting the data at the same time. So once the data comes in, and whoever has the best algorithm which can process it really quick, they get the they have a little bit very less turnover time and they make more money out of it. So history of HFTs. So how did HFT start, and like what was the initial first time when HFTs can come into picture? So those kind of things. Let's see now. Uh, so if you see the very crude uh, form of trading, like algorithmic trading, that dates back to 17th century, where people use technology to access information at much faster rate. So this was the stepping stone for people to start thinking about like how can we leverage technology in like spreading information. This is in 17th century. Like there used to be a saying that like in Nathan Mayer Rothschild, who is an English German banker and a financier, he knew the victory of Duke of Wellington over Napoleon at Waterloo even before the government of London did know about the victory. So that is how technology was used at that time. And in 19th century, we have been seeing telegraph cables and pigeons to run news delivery systems. So people started to actually deliver news using telegraph cables, which was in the 19th century. Also, they said that in the 19th century, Julius Reuter, the founder of Thomson Reuters, he used a combination of technology, including telegraph cables and a fleet of carrier pigeons to run news relay system. So wherever a region where he could deploy telegraph cables, he did that. And in regions where there is no less scope for deploying telegraph cables, he used a fleet of carrier pigeons to run the news relay system. So in this way, the information would reach Julius Reuter much before anyone else in the city would know it. Yeah. So if the first very formal official trading firm started in 1983 with Nasdaq introducing the fully fledged electronic trading system. This was the very basic stepping stone for HFTs to come into picture. And in 2000s, HFTs accounted for less than 10% of the equity orders, but they were seeing a very rapid growth at that time. And in 2001 time frame, the HFTs had an execution time of several seconds, which kept improving further. So execution time basically means that the amount of time in which they take to place an order. In the 2005 to 9 time frame, as per New York Stock Exchange, the high frequency trading volume almost grew by 164%, which is like a huge 1.5x times the growth. And uh, in 2010, the latency from in 2001, which was several seconds. In 2010, it became almost to milliseconds, and in the later year, they even into microseconds. And subsequently, in 2012, when with the boom of technology and FPGAs, it almost reached to nanosecond scale. This is how the HFTs got evolved over the time. Now let's look at some of the early players who were in the HFT market. Island DCN, which was founded in 1996 by Matt Anderson and Kevin Compton, is the first known HFT as per history. It is an electronic communication network that allowed traders to match, buy, and sell orders without the need for regional exchange. So, like unlike traditional exchange, which used people to go there, place a order and buy a stock or something, it used the electronic communication networks to place order over the wire. And in mid 1990s, Goldman Sachs also developed a proprietary trading system called SigmaX that used advanced algorithms to execute trades. So this was also one of the major milestone if we see in how HFTs started to evolve. This system, the Sigma X, was designed to take advantage of small price discrepancies in the market, and it also executed trade very quickly and efficiently. So this is also the reason why HFTs basically started to um, make more profit out of the small price discrepancies in the market. Sigma X was one of the first examples in that case. Following this, other larger trading firms like in investment banks like JP Morgan, Morgan Stanley, and UBS started developing their own HFT strategies and trading systems. So HFTs is all about speed. So by this time, when we looked at all these things, like it is evidently clear that like whichever company has the best at trading algorithm and can execute them in a really faster speed, he's gonna be the market player all over there. So now FPGAs or any other electronic system which can reduce the latency to a large scale will be the one which every company wants to adapt. And in that case, FPGAs is much more efficient and better. Let's see why is it so in the coming slides. So why FPGAs in HFT? So first, before going there, let's see what are FPGAs. FPGAs contains like millions of configurable logic blocks. Here, logic blocks or LUTs basically means that a combinational cell which can be programmable or configurable in this case, and they perform the basic logical operations like AND or XOR, NAND or NOR. So LUTs, they are connected in a specific order using switches to form an algorithm. So here you can see the black ones, the gray ones, they are the logic blocks, and the vertical and horizontal lines are the programmable interconnects, which are basically used to connect them to the input and output cells. And they are there basically from the switch in routing one combination cells output or input to other things. And the other advantage which they give is the programmability and extensive capacity in which they can be reconfigurable. So if you take ASICs or CPU, a CPU is a completely different story because it has multiple layers and the abstraction is so huge that it takes much more amount of time in executing an algorithm. But if you take ASICs, they are hard coded or sort of if you say like once the ASIC is made, we can be configuring the algorithm after a certain point of time. But FPGAs, they provide a flexibility in reconfigurability. So that is why uh, many HFTs like tend to use FPGAs which are on-field programmable. So today's FPGAs almost have mega million gates. Oh, yeah, that is the scope at which FPGAs are evolving now. Now, how did FPGAs start? So let's take a look at the history of FPGAs as well. In Altera in 1984, delivered the first programmable logic EP300, which used quartz window to shine an UV light on the die to erase EEPROM cells. So this is the first known instance of how a programmable logic was embedded in on real hardware. So using an UV light, they basically erase the EEPROM. It's just electrically programmable RON cells. They basically use the EV light to erase it and again reprogram it. This is in 1984. Yeah, Xilinx in 1985, they made the first commercial FPGA which had 64 configure logic. So it's three input lookup tables. So this was XC2064, which is the first commercial FPGA from Xilinx. In 1990s, there was a rapid growth for FPGAs, both in circuit sophistication and as well as the volume of production. So the FPGAs system itself became much more complex and sophisticated. And similarly, the amount of production market trying to adapt it also increased. So the volume of production as well went up. By the end of the decade, FPGAs was almost there at every place in consumer electronics and automotive industrial applications. Almost every industry switched to FPGAs, which was earlier depending on multiple ASICs. In 2013, Altera had almost 31 percentage of market share, Actel 10%, Xilinx 36%. So these three companies together almost represented 77% of FPGA market. And in also we have lately seen in 2014 and 2018 that Microsoft began using FPGAs to accelerate Bing And also in 2018, it used FPGAs in accelerating their data center workloads for Azure cloud. So these are a few examples how FPGA based systems are becoming much more popular. Yeah. So why FPGAs? Mm, So the processing paths in this hardware are completely parallel. Thus, a single FPGA can have 10 or more control loops running on it simultaneously at different rates. So since they are all having config logic blocks, we can basically group a few set of config blocks in performing a certain function. Similarly, other set of logic blocks can be grouped to form another function or something. So in this case, like we can have multiple parallelized algorithms running simultaneously on on the same hardware. So, in algorithms that can be broken down into a set of simple tasks will be much more efficient in this case. As we saw the parallel architecture in the previous instance, now when we have a complex algorithm, we can break down into similar smaller functions, and those smaller functions can be in turn used to compute the complex value. Yeah, and the hardware implementation of the algorithm results in high level of determinism, and this is resilient to intermittent failures or traffic in a network. So, unlike CPU, which has multiple layers being involved in the computation, here there is only a single layer, and that is why it is sort of deterministic, and there is no multiple things running in parallel traffic, CPU traffic or the network traffic. Those kind of things are very low here, and it is much resilient to intermittent failures. Thus, if you give a simple input to some algorithm now, the same algorithm, if you give the same input even at a different point of time, you will be getting the same result at any point of time. So that is the main another advantage of determinism here. So with respect to the network conditions, the chip always passes the same sequence of states, providing the same output for every given input at every point of time. Yeah. So how HFTs use FPGAs? Yeah. So in a simple HFT system, architecture always includes three major components: the input of a live market order data, it takes the data as an input, and the output it basically gives the trading orders, places them by yourself, and in between there will be writing the trading strategy, which implements the trading algorithms. So the ways in which FPGAs are leveraged include passing the incoming data, providing data filtering, decoding, and normalization. This is on the input side. It also performs the pre-trade volume and price computation and collateral checks. It also monitors the value and loss scenarios of financial portfolios on an ongoing basis. So this is to like sort of have a recovery mechanism. Also, it calculates the yields from the investments and prices of securities and the derivatives. And finally, it also generates the outgoing orders and transmitting them to the machine engines. Yeah. So this is high-level block diagram of HFT system. So from the market, NS, the stocking the servers, we get the market data, and this market data goes to a parcel, which basically is the quad small form factor. So this is a type of a compact transceiver which supports multiple networking protocols, and it converts them into the PCI Express thing. So then this QSFP basically passes the data and gives that to the FPGA. The FPGA handles all the passing of the data, and then performing the trading algorithms, and then calculating the orders. Once that is done, this again puts back them on the QFSP, and it places the orders. For the software to have a control over that, we have a PCI Express, which is a high-speed bandwidth protocol, which is used by for the trader or the monitor who's actually looking monitoring the trade. He can look at what trade has been going on. Yeah, but nothing comes for free. So how secure are FPGAs? Let's take a look at the security aspects of them. Yeah. So HFTs deal with proprietary trading strategies and algorithms because they are once someone gets their algorithm back out, it is all completely gone. So that's why they obfuscate most of the algorithms and designs in order to keep them secure. To maintain secrecy in them, they usually operate with very small teams and have all the infrastructure in-house or minimally outsourced to trusted parties. So instead of sharing their code base or things with multiple people outside, they just we work with a very minimal team as per the requirement, and also they don't outsource many of those things. As much as possible, they try to make everything in house, and if at all there's any need for outsourcing, they basically use that like have huge amount of NDA and non-disclosure agreements to only to trusted parties. So also FPGA manufacturing itself involves multiple parties, and it involves strict quality checks and security checks. Because like maybe like when someone designs some mark, as we see, there is only Xilinx, Alter, and Actel. They hold a huge share of uh, the FPGA market. So when the FPGA design itself had some bug wherein like data can be exposed out, so in that case, it can't be figured out by the HFT firm who's been using this. So thus the FPGA manufacturing itself involves quality and multiple quality and security checks. Also, HFTs consume large amounts of data and are prone to cyber attacks. So as you see, like for predicting the market trend or something, they basically log all the market data, and also they use pre market data to check out how each and every stock is going to perform. So thus they'll be dealing with huge amount of data. So all these data are really highly potential to cyber attacks. So FPGAs are itself vulnerable to hardware level attacks such as side channel attacks and hardware trojans as well. So let's take a look at the boon and bane of HFTs and how they're impacting the market. So first, let's take the positive impact. So one thing is they improve the efficiency of the market. That is, they provide liquidity to the market and help facilitate price discovery. So, for example, in 2020, Virtue Financial, a leading HFT firm, reported that they provided liquidity to markets on 99% of the trading days. So this is a huge thing for the firm. Also, they work with tighter bid-ask spreads. So this helps to reduce the bid-ask spreads, and which benefits all the market participants. For example, in a study conducted by European Securities and Markets Authority, found that HFTs were able to tighten spreads up to 30%. Also, they increase the trading volume itself. That is, like they generate a significant amount of trading volume, which helps to improving the market depth and the stability. If you take a real world example, according to Chicago Mercantile Exchange, HFTs accounted for over 50% of the trading volume in E-mini and SP 500 futures market in 2020. Also, they pave way for many technological innovations. So, use of FPGAs in HFTs paved the way for the multiple technological innovation in the industry, leading to development of new trading strategies and as well algorithms. So, for example, Jump Trading, which is a prominent HFT firm, it is known for its expertise in using FPGAs to develop low latency trading strategies. Also, improved risk management. So, HFTs use sophisticated risk management techniques and tools to manage their exposure to market risks. So, which helps in reducing the overall market volatility. Yeah. So, for a real world example, Tower Research Capital, a leading HFT firm, again, it uses machine learning algorithms to direct and manage market risk in real time. Yeah. Challenges and risks. So, of course, everything comes with its own challenges and risks. So, let us see what are the risks involved. So, latency. So, the speed of execution is critical for HFTs as they aim to buy or sell stocks within a few microseconds or nanoseconds of market moving events. So, if you see in 2013, a trading firm lost almost 440k dollars in just 30 seconds due to 1 millisecond delay in executing a trade. So just think of how much important latency is. Also in 2010, a firm lost 4.1 million dollars when it failed to execute trades quickly enough to during a sudden market movement. Yeah. In 2012, a software glitch at the Nasdaq Stock Exchange itself caused a 30-minute delay in opening of Facebook IPO, causing losses for HFTs who had already placed trades based on the pre-market data. Yeah, so this is a huge loss for those firms. That is why latency plays an important role here. Regulations coming to other thing. So HFTs operate in a highly regulated environment because they hold a huge market, and also they execute trades in really high volumes. They can cause the markets they control the market stability almost. So that is why they have multiple regulations put forward by the security exchanges. So in 2015, Barclays almost paid $70 million to settle charges that it misled clients about the role of HFTs in the trading venue. Also, in 2021, Virtue Financial paid almost $8.5 million to settle the charges because it violated the Security Exchange Commission's rules related to short selling. Yeah, and market volatility. HFTs thrive in a market environment that is stable and predictable because they use algorithms to exploit small price movements. So that is why they have a huge control over the market volatility. In 2020, HFT firms were blamed for exacerbating the market crash caused by COVID-19 pandemic. This is a huge thing. And also in 2018, HFTs lost money during a sudden drop in the stock price of Facebook, with some firms reported losing tens of millions of dollars. Yeah. Also they work in a highly competitive environment. That is why the firms constantly tend to adapt to latest technology and try to bring up much more and more innovations. So in 2021, Jane Street, one of the largest HFT firms, reportedly spent $1.3 billion on technology and other expenses. This is a huge thing. And technology failure. So, I mean, any technology is prone to its own shortcomings and failure. So, that is why the reliance of complex technology and software systems means that they're much more vulnerable to complex technical failures, such as system crashes or software glitches. So, in a real example, in 2012, Knight Capital Group almost lost 440 million in just 30 minutes due to a software glitch that caused a firm to execute trades in wrong stocks. In 2015, a stock software glitch at the New York Stock Exchange caused a 3.5 trading halt, affecting many HFTs and other traders. Data quality. So HFTs, again, as I said, rely on much accurate and real-time data to perform their trading strategies in a much more efficient way. So this poor quality data or incorrect data can lead to losses or missed opportunities. So in 2012, Nasdaq was fined $10 million by SEC for poor systems and controls that lead to trading losses for HFTs. So the stock exchange itself was fined by the SEC for maintaining a poor data transmission thing. In 2013, a trading firm sued a data provider for providing inaccurate information that led to $3.3 million in losses. Yeah. So this is how expensive each and everything other than the HFT industry. So what are the current trends? Let's see. The market growth, we have seen a significant increase in the market growth over the entire last decade. The market size is estimated to be around $21.8 billion in 2020, which was projected, again, it was projected to grow at a CAGR of 4.9% from 2021 to 2028. So CAGR stands for the compound annual growth rate. So basically, like each and every year, it expected to grow about 5%. Industry share, it has a significant share of the trading volumes in major markets such as US and Europe, and estimates suggest that HFTs account for more than 50% of the trading activities in all these markets. Global expansion. So, in the earlier stages, they were much more prominent in US and Europe, and slowly they are expanding all over the world, particularly in Asia. In 2022, the Singapore exchange saw a 20% increase in the HFT trading volume, and this growth was driven in part by the expansion of HFTs from into the region. Yeah. So, what are the future scope? Mm, so, machine learning is used for analyzing the vast amounts of data in real time, enabling traders to make better decisions and improving their trading strategies. Quantum computing has the potential to revolutionize HFTs by enabling traders to perform complex calculations at a speed beyond which is possible with classical computers or even FPGAs. In blockchain technology, it offers potential for increased transparency and security as well. Big data, again, as we said, data is everything here, so it provides ability to handle and analyze large amounts of data in real time. Predictive analytics using ML and other techniques to identify patterns in market data also bring up more efficient risk management systems. Yeah. So I think like with all these innovations coming in place, the HFT firms are going to be a huge crucial thing in the trading industry even in the upcoming years. Yeah. That's all I have, and thank you for time.